The year is 1694, and in a dimly lit chamber overlooking the Thames, candlelight flickers across weathered faces gathered around polished oak. The air is thick with tobacco smoke and the weight of decisions that will echo through centuries. Outside, London bustles with the commerce of an empire. But inside this room, something quieter is taking shape. Parchment rustles as quills scratch across contracts that few will ever read, fewer will understand, and none can imagine will still govern the world 300 years later. What they're creating isn't meant to last forever. It's simply meant to solve today's problem. But here's what should make you pause and consider the world you inherited. Every dollar in your wallet, every government bond, every central bank balance sheet traces back to this moment when a small group of merchants made a decision that seemed perfectly reasonable at the time. They had no idea they were designing the financial DNA of the modern world. Today, when the Federal Reserve creates money, when governments issue debt, when economists speak of quantitative easing, they're operating inside a system that emerged from that candlelit room in 1694. And here's the paradox that sits at the heart of everything. If the Fed prints money, who exactly is it owed to? The answer isn't what you think, because when you follow the chain of obligation, when you trace the flow of interest payments, when you understand who ultimately benefits, you discover something that changes how you see every transaction, every tax payment, every economic policy announcement. The money isn't owed to foreign powers or shadowy cabals. It's owed to a system that evolved into a self-sustaining framework over centuries of financial development, a system that learned, over time, to operate through well-established institutional processes rather than any hidden or external authority. But systems don't design themselves. They evolve through human decisions, each one logical in its moment, each one creating consequences no one foresaw. And to understand who really benefits when new money enters the world, you need to see how rational people facing real pressures built something that would outlast empires. William Paterson never intended to reshape civilization. In that London chamber, he was simply a Scottish merchant who'd failed at several ventures and needed one more chance to prove himself. The year 1694 found England exhausted by war with France, the royal treasury empty, and King William III desperate for funds that traditional lenders refused to provide. England had defaulted before. Creditors had learned to be cautious. But Paterson approached the king with an idea that seemed brilliantly simple. Instead of borrowing money that would eventually be repaid, what if the government borrowed money and paid interest forever? The mechanics were elegant. A group of wealthy merchants would provide £1.2 million to the crown. The government would pay 8% interest annually from tax revenue. But here's the innovation that would echo through centuries. The principal would never be repaid. The loan was permanent. And to manage this arrangement, Paterson proposed creating an institution that would stand between the lenders and the government, the Bank of England. What Paterson didn't realize was that he was solving two problems at once. The government got its war funding. The merchants got a guaranteed income stream backed by the government's power to tax. But he was also creating something unprecedented, government debt that would never disappear. And here's where the story takes its first turn toward the world you inhabit today. The merchants weren't just lending money. They were buying an annuity from the government. As long as England existed, as long as it could tax its citizens, the payments would flow. But Paterson's real genius, the part that would reshape how money itself worked, came next. The Bank of England was granted the right to issue banknotes backed by the government's debt. They could print paper money up to the value of the loan. This created something that had never existed before, money made from debt, or more accurately, a monetary framework built on government-backed obligations, which later became a standard feature of modern economies. The government's promise to pay became currency itself. Think about what this meant. The more the government borrowed, the more money could be created. Debt wasn't a problem to be solved. It was the foundation of the monetary system. And every time someone used those banknotes, they were participating in a system where government obligations had become the medium of exchange itself. But here's what Paterson couldn't have foreseen. Within 50 years, every major European power had copied the model. France created its own central bank. The Netherlands formalized government debt issuance. And by 1790, the newly independent United States, through Alexander Hamilton, explicitly modeled its financial system on the Bank of England permanent debt. Interest paid from taxes, bonds traded as currency. The template was spreading. What started as one man's solution to one country's war funding had become the blueprint for how nations would manage money. And at the center of it all was a principle that seems almost mystical when you really consider it. The system worked because everyone agreed that government promises were sufficiently reliable to underpin financial transactions, more stable than anything physical you could hold in your hand. By the early 1800s, the system Paterson created was functioning across Europe, but it remained fragmented. Each loan was was negotiated individually. Interest rates varied wildly. Only the wealthiest merchants could participate. Then Nathan Rothschild arrived in London, and what had been a collection of separate arrangements became an industry. The Rothschild family had built something unprecedented. Banking houses in London, Paris, Frankfurt, Vienna, and Naples. A network that could move money across borders faster than anyone else. Faster even than governments could communicate with their own ambassadors. And Nathan, operating from London, saw an opportunity that would transform sovereign debt from a series of individual transactions into a global market. Instead of lending directly to governments, Nathan began buying government bonds at a discount and reselling them to investors at a markup. He created what we now call a secondary market. Governments got their money immediately. Nathan collected the spread, and investors got tradable assets that paid reliable returns. But here's where the story becomes something larger than individual profit. Nathan didn't just finance governments. He positioned himself so that governments had strong incentives to use his services. His courier network was faster than official channels. His information was more reliable than government reports, and his ability to distribute bonds to investors across multiple countries meant he exerted significant influence within emerging global markets, shaping access to capital itself. The famous story of Waterloo illustrates the power he'd accumulated. When Nathan learned of Napoleon's defeat before anyone else in London, he used that information not just to profit, but to demonstrate something more fundamental. He influenced the flow of information that determined bond prices. He connected investors who bought government debt. He facilitated the mechanism by which nations funded themselves. What Nathan had created was something that hadn't existed in Paterson's time, a web of interconnected obligations that crossed borders, currencies, and political systems. A British bond might be owned by a French investor who sold it to a German bank who used it as collateral for a loan to an Austrian merchant. The complexity meant that when a government considered defaulting, they weren't just refusing one creditor, they were affecting an entire international financial network. This is where the system evolved from permanent debt into something more sophisticated, highly interconnected debt, because the cost of default was no longer just embarrassment or higher future borrowing costs. Default meant disrupting the financial relationships that enabled trade, investment, and economic activity across multiple countries. What they didn't realize was that they were building the foundation for something that would eventually span the global system, where every nation's debt would become interconnected with every other nation's debt, where central banks would emerge to manage these relationships, where the money itself would become inseparable from government obligations. And here's where the story moves toward the question that brought you here. If money is created from debt, and debt never disappears, who ultimately benefits when new money enters the system? The answer lies not in London banking houses of the 1800s, but in a quiet revolution that would occur in America a century later, when influential policymakers and financiers would gather privately to design the next stage of the country's financial infrastructure, a development now viewed as part of the natural maturation of the US banking system, rather than a covert restructuring. The year is 1910, and on a remote island off the Georgia coast, the Atlantic wind carries salt and secrets through Spanish moss that has witnessed centuries of American transformation. Jekyll Island sits in November darkness, its grand hotel empty except for a small gathering of men whose names would reshape how money itself functions. They arrive separately, using false identities, carrying luggage that conceals documents more valuable than the gold standard they're about to abandon. The ocean whispers against the shore as oil lamps flicker in windows, where key financial and political figures drafted what would become the Federal Reserve Act, a process that was private but consistent with the political sensitivities of the era. What they create in those 9 days of isolation will seem, to future generations, like the natural evolution of financial systems. And historically, it is now understood as a politically sensitive but ultimately formal step toward modern central banking. But here's what the salt air and flickering flames couldn't reveal to them. They're not just solving America's banking problems, they're letting a transformation that began in that London chamber 2 centuries earlier. A transformation that will make every dollar you earn, every debt you carry, every economic crisis you witness, part of a system so elegant in its complexity that no one person can see its full shape. By 1907, America had grown into an economic giant, but its financial system remained primitive compared to European models. Banks operated independently across vast distances. Money supply fluctuated with gold discoveries and seasonal crop cycles. And when panic struck, as it did that autumn, there was no mechanism to prevent collapse except the personal intervention of one man, John Pierpont Morgan. At 70 years old, had become America's unofficial central banker, not through government appointment, but through sheer accumulation of financial power. When stock prices crashed and banks began failing, Morgan gathered New York's most powerful financiers in his private library, locked the doors, and refused to let anyone leave until they pledged their own fortunes to stabilize the system. It worked, but Morgan understood what others couldn't yet see. America needed permanent machinery to manage what he'd accomplished through force of personality. The problem was political. Americans had fought two central banks in their history, dismantling both through populist opposition. The very phrase central bank triggered memories of foreign control and concentrated power that violated the nation's founding principles. So Morgan and his associates designed something more sophisticated than direct control. They would create the appearance of decentralization while ensuring banker influence over the essential mechanisms. The meeting on Jekyll Island brought together Senator Nelson Aldrich, whose daughter had married into the Rockefeller family, along with representatives from the largest financial houses in New York for 9 days. They crafted legislation that would look like government oversight while functioning as banker coordination. What emerged was brilliant political theater. The Federal Reserve wouldn't be called a central bank. It would be a system of 12 regional banks, suggesting geographic distribution of power. It wouldn't be controlled by Wall Street. It would be overseen by a board of governors appointed by the president, suggesting democratic accountability. But the structure ensured that technical expertise from the banking sector could inform monetary policy, while still operating under a framework of public governance. The regional Federal Reserve banks would be privately owned by member banks. Those member banks would elect the boards of the regional feds, and the most critical power, the ability to create money and purchase government bonds, would rest with the Federal Reserve Bank of New York, reflecting the financial importance of New York's economy at the time, rather than any hidden concentration of power. The Federal Reserve Act passed Congress in December 1913, largely because most representatives didn't understand what they were voting for. What they created was something that seemed impossibly complex, but operated on a principle so simple it could be written on the back of an envelope. When the government needs money, it issues bonds. The Federal Reserve creates new money and buys those bonds. The government spends the money. The debt goes on the Fed's balance sheet, and the majority of the profits from these operations ultimately flow back to the US Treasury under existing laws, forming part of a long-established fiscal structure rather than a hidden mechanism. Between 2011 and 2021, the Federal Reserve sent over $900 billion to the Treasury, not as loans, as profits from the very system that creates money from government debt. This is the answer to the question that brought you here. When the Fed prints money, who is it owed to? It's owed to a system that learned across 3 centuries of evolution to function through a cycle in which government debt and central bank operations interact within a legally defined framework. The government borrows from an institution that sends its profits back to the government. The debt exists, the interest payments flow, but the ultimate beneficiary is the same entity that created the obligation. But here's what makes this more than just an accounting curiosity. The system works because everyone agrees to participate. When you accept dollars, when banks hold reserves, when governments issue bonds, you're all operating inside a framework that treats promises as more valuable than physical reality. Not because of mysticism, but because legal, institutional, and economic trust gives those promises real power. The money in your wallet isn't backed by gold or silver or anything you can touch. It's backed by collective faith in institutions that emerged from decisions made by people who died centuries before you were born. This is the quiet truth that sits beneath every economic transaction you'll ever make. The system never set out to create this circularity. It evolved there through individual responses to immediate pressures, each decision rational in its moment, each creating consequences no one could foresee. From Paterson's war funding to Rothschild's bond markets to Morgan's crisis management, rational people solving real problems built something larger than any of them imagined. The debt isn't owed to foreign powers or shadow organizations. It's owed to a system that grew through centuries of adaptation, a system that learned to function through institutional continuity rather than deliberate design, a system that sustained itself by owing money to itself. And you participate in it every time you earn $1, spend $1, or trust that the promises written on paper will be honored tomorrow. If this changed how you see the machinery that governs your economic life, if you want to understand the patterns that shaped the world you inherited, then you're beginning to see how 3 centuries of rational decisions created something that no one planned but everyone depends on.